There's a chart on my screen right now that I think deserves a lot more attention than it's getting. And strangely enough, it isn't a silver price chart. It's the gold to silver ratio. As of August 1st, 2026, gold is around $4,043 an ounce, while silver is around $57.60. That puts the gold to silver ratio at roughly 70 to 1. In other words, it takes about 70 ounces of silver to equal the value of 1 ounce of gold. Now, here's why I think that matters. Earlier this year, the ratio was dramatically higher, and over the last several years, we've repeatedly seen this ratio push toward the upper end of its historical range. But now silver has been catching up, and that changes the entire conversation, because while some silver commentary is still focused on the same old stories, manipulation, suppression, secret vaults, fake shortages, and an imminent squeeze, the chart itself has already started moving. Silver has been outperforming gold, and JP Morgan Global Research is now forecasting an average silver price of around $81 an ounce for 2026. That's more than double silver's 2025 average of roughly $40. But here's the important part. JP Morgan isn't saying $81 is guaranteed. In fact, its own research points out that silver can be extremely volatile and that industrial demand, investment demand, and the gold to silver ratio all matter. So this isn't a video about promising you that silver is going to $100 tomorrow. It's about something much more interesting. The chart, the supply and demand numbers underneath it, and the reasons this entire bullish setup could still fail. Because if we're going to talk about silver seriously, we have to look at both sides. So let's start with the chart. The gold to silver ratio is one of the simplest ways to compare the relative performance of these two metals. You take the price of gold and divide it by the price of silver. That's it. When the ratio rises, gold is outperforming silver. When the ratio falls, silver is outperforming gold. And that's exactly what makes the recent move interesting. For years, the ratio repeatedly traded at elevated levels. We've seen it around the mid-80s and even higher during periods when silver was dramatically underperforming gold. During the extreme market stress of 2020, the ratio even moved above 125 to 1, but those extreme numbers don't last forever. And that's the first lesson here. The gold to silver ratio is not a law of nature. It doesn't have to return to a specific number. But historically, when the ratio gets extremely stretched, a major question eventually appears. Does gold continue pulling away from silver, or does silver start catching up? Right now, we're watching the second story. And that's why the move from the high 80s area toward roughly 70 deserves attention. Not because 70 is some magical number, but because the direction has changed. Silver is closing the gap. And when you combine that with the physical supply picture, the story gets much more interesting. Before we get into the bigger picture, I want to give you 3 numbers. Not predictions, not opinions, just numbers. Number 1, the latest Silver Institute World Silver Survey shows that the silver market remains in deficit. In 2025, global silver demand exceeded supply by about 40.3 million ounces. That was the 5th consecutive annual deficit. And for 2026, Metals Focus and the Silver Institute forecast another deficit of approximately 46.3 million ounces. That would make it the 6th consecutive year in which demand exceeds supply. Number 2, the 2026 survey estimates total silver supply at approximately 1.066 billion ounces. Demand is forecast at around 1.113 billion ounces. That difference is the 46.3 million ounce deficit, and that distinction matters, because a deficit doesn't mean the world literally runs out of silver. It means annual mine supply, recycling, and other sources aren't enough to satisfy total demand. The difference has to come from inventories that already exist above ground. Number 3, the gold to silver ratio is now around 70 to 1 based on the approximate August 1st prices we're using. So you've got 3 separate pieces of information: a multi-year supply deficit, a physical market that continues to rely on existing above-ground inventories, and a gold to silver ratio that has compressed substantially from the much higher levels seen earlier in the cycle. Now we need to understand what these numbers actually mean, because this is where silver gets misunderstood. There are essentially 2 sides to the silver market. There's the physical market, bars, coins, industrial material, jewelry, manufacturing, solar panels, electronics, and then there's the financial market, futures, ETPs, trading positions, investment flows, and paper contracts. These markets interact constantly, but they aren't identical. And one of the biggest mistakes in silver commentary is treating a warehouse inventory number as if it represents every ounce of silver on Earth. It doesn't. A COMEX warehouse figure tells you something about silver held within the exchange's approved warehouse system and the classifications used for futures delivery. It does not tell you how much silver exists in private hands around the world. It doesn't count every ounce sitting in India. It doesn't count every industrial inventory. It doesn't count every piece of jewelry. And it doesn't represent every ounce held by ETFs or other institutions. So when warehouse stocks decline, the correct interpretation isn't, the world is running out of silver. The better interpretation is, available inventories in a particular part of the market are changing. That's a much more useful way to think about it. And this brings us to the real question. Why does silver have a structural demand base at all? Silver isn't just a precious metal, it's also an industrial material. And that's one of the reasons this metal behaves differently from gold. Silver is used in electrical and electronic applications, photovoltaics, brazing alloys, automotive applications, and many other industrial processes. According to the 2026 World Silver Survey, industrial demand remains the largest major demand category, even though the forecast for 2026 is lower than 2025. And that brings us to one of the most important corrections to the usual silver narrative. Industrial demand isn't simply going straight up. The 2026 forecast actually shows total industrial fabrication declining from approximately 657 million ounces in 2025 to about 640 million ounces in 2026. That's a decline of roughly 3%. So if someone tells you industrial silver demand is exploding every single year, that's too simplistic. The real story is more complicated. And the most obvious example is solar. In 2025, photovoltaic applications consumed approximately 186.6 million ounces of silver. For 2026, the forecast is around 151 million ounces. That's roughly a 19% decline. At first glance, that sounds extremely bearish. If solar is one of silver's most important industrial uses, and solar is using less silver, shouldn't the silver deficit disappear? Not necessarily. And here's why. There are two completely different things happening at the same time. First, manufacturers are reducing the amount of silver used per unit of solar capacity. That's called thrifting. And in some applications, manufacturers can substitute away from silver altogether. That's real, it's important, and it's a legitimate long-term risk for silver investors, but at the same time, global solar deployment can continue expanding. So the question isn't simply how much silver goes into one solar panel. The question is, how much silver is consumed across the entire global solar industry? Those aren't the same thing. If the amount of silver per panel falls faster than solar installations grow, demand falls. If installations grow faster than silver intensity falls, demand can remain substantial. And that's exactly why you can't analyze silver by looking at one number. You have to look at the entire system. And according to the Silver Institute's latest forecast, even with lower photovoltaic demand and softer overall industrial demand, the total market is still expected to remain in deficit by approximately 46.3 million ounces in 2026. That's the important point. The deficit hasn't disappeared, but neither should we pretend demand is accelerating everywhere. Both things can be true at the same time. Now we get to the supply side. This is one of the most misunderstood parts of the silver market. A large share of silver production comes as a byproduct of mining other metals. That means silver production isn't always determined by the silver price itself. If the price of silver doubles tomorrow, a copper mine doesn't suddenly become a silver mine. A lead-zinc operation doesn't instantly double its production because silver is more expensive. The economics of the primary metal still matter. That creates an interesting supply dynamic. Silver prices can rise dramatically without instantly creating a massive wave of new silver production. New mines take years. Permitting takes years. Financing takes years. Construction takes years. And even existing mines can't always increase output immediately. That's one reason silver supply can be relatively slow to respond. But again, we have to be careful. This does not mean silver supply is permanently fixed. Recycling increases when prices rise. Existing mines can expand. New projects can come online. And higher prices can eventually encourage more supply. The Silver Institute's 2026 survey actually forecasts total supply increasing, including stronger recycling. So the argument isn't supply can't increase. The argument is supply may not respond quickly enough to every change in demand. And that distinction matters. Now let's bring everything back to the chart. Gold around $4,043, silver around $57.60, ratio around 70-1. Here's where the mathematics becomes interesting. If gold stayed at approximately $4,043 and the ratio moved to 65-1, silver would be approximately $4,043 divided by 65. That's about 62.20 silver. If the ratio moved to 60-1, silver would be approximately $67.38. And if the ratio moved to 50-1, silver would be approximately $80.86. Now stop right there. Those are not price predictions. They're mathematical scenarios. That's a huge difference. I'm not saying silver is going to $80.86. I'm saying that if gold remained around $4,043 and the gold to silver ratio compressed from 70 to 50, the mathematics would require silver to trade around $81, and that's why the ratio matters. It gives us a framework. It lets us separate the price target from the story. And here's where JP Morgan becomes interesting. JP Morgan Global Research sees silver averaging approximately $81 per ounce in 2026. That's remarkably close to the mathematical result you'd get from a 50-to-1 ratio at today's approximate gold price. But again, don't confuse these two things. JP Morgan's $81 forecast is a research forecast. The $80.86 figure is simply arithmetic. One is an estimate, the other is a calculation. This is where I want to slow down, because the bullish case becomes dangerous if you assume mean reversion is guaranteed. It isn't. The ratio can remain elevated for a very long time. Gold has something silver doesn't have to the same degree: central bank demand. Central banks around the world hold and purchase gold as a reserve asset. Silver doesn't have the same institutional demand structure. JP Morgan itself points out that silver lacks the same structural central bank buying that supports gold. That means gold can continue receiving powerful investment flows even when silver isn't keeping pace. And if that happens, the ratio could remain elevated. Maybe 70, maybe 75, maybe even higher. Silver could still rise in price while underperforming gold. That's the first major risk. The second risk is technological. Silver is valuable partly because of its industrial properties. But those same properties make it expensive. When silver prices rise dramatically, manufacturers have an incentive to use less of it. They improve efficiency. They reduce silver loading. They redesign manufacturing processes. And eventually they search for substitutes. That's exactly what we're already seeing in photovoltaic applications. The Silver Institute expects photovoltaic silver demand to fall from approximately 186.6 million ounces in 2025 to around 151 million ounces in 2026. That's a meaningful decline. So if thrifting accelerates faster than solar capacity expands, silver demand could weaken significantly. And that would challenge the deficit thesis. There's another risk that doesn't get enough attention. Silver is partly a precious metal, but it's also an industrial metal. That means a major global economic slowdown could hit silver from both directions. Investment demand could weaken, industrial demand could weaken, manufacturing could slow, electronics production could slow, construction could slow, and suddenly the very industrial exposure that makes silver exciting becomes a weakness. That's something gold doesn't face to the same degree. So silver is not simply gold with more upside. It's a different asset with a different risk profile. This is the part I think matters most. The chart does not tell us silver must go to $100. It doesn't tell us buy now. It doesn't tell us the market is being suppressed, and it certainly doesn't tell us a short squeeze is guaranteed. What it does tell us is that silver has already started outperforming gold. The ratio has compressed significantly from the much higher levels seen in previous years. At the same time, the fundamental backdrop still shows a multi-year supply deficit. The 2026 Silver Institute data projects approximately 1.066 billion ounces of supply against about 1.113 billion ounces of demand. That's a gap of roughly 46.3 million ounces. And JP Morgan is forecasting an average 2026 silver price around $81. So you've got a chart story, you've got a supply story, and you've got a major institutional forecast, but you've also got real risks. Industrial demand is forecast to decline in 2026. Solar silver usage is falling because of thrifting and substitution. Recycling is increasing. Supply is increasing. And gold still has a structural central bank demand advantage. That is the real silver story. Not a conspiracy, not a guaranteed squeeze. A market caught between tightening physical fundamentals and powerful forces trying to reduce silver consumption. So if I had to reduce this entire video to 3 scenarios, here they are. Scenario 1, the ratio continues compressing. Silver keeps outperforming gold. Physical deficits remain. Investment demand stays strong, and the ratio moves towards 60 or even 50. Under that scenario, with gold around today's level, silver mathematically moves toward roughly $67 to $81. Again, that's scenario math, not a prediction. Scenario 2, the ratio stops compressing. Gold continues outperforming. Silver remains supported by industrial demand and investment demand, but the ratio stays somewhere around 70 to 80. Under this scenario, silver can still have a bull market. It just doesn't produce the explosive catch-up move that silver bulls are expecting. And scenario 3, the industrial slowdown becomes bigger. Solar thrifting accelerates, recycling increases, mine supply improves, investment demand weakens, and the deficit narrows or disappears. In that environment, the gold to silver ratio could widen again, and silver could underperform badly. Those are the three scenarios I would keep on the screen, not because I know which one will happen, but because they give us a framework for watching the data. And that brings us back to the chart we started with. The gold to silver ratio is not a crystal ball, it's a scoreboard. It tells us whether silver is gaining or losing ground relative to gold. And right now, silver has been gaining ground. At the same time, the physical market remains structurally tight enough that the Silver Institute expects another annual deficit in 2026. But the bullish case isn't perfect. Industrial demand is not rising everywhere. Solar demand for silver is falling. Thrifting is real. Recycling is rising. Supply is rising. And gold has a powerful structural demand engine that silver simply doesn't have. That's why I think the most interesting question isn't, is silver going to $100? The better question is, what happens to the gold to silver ratio if the supply deficit continues? Because if gold remains strong and silver starts catching up faster, the ratio becomes one of the most useful charts to watch. And if the ratio suddenly turns higher again, that's information too. It could tell us that gold is regaining leadership. It could tell us investment demand for silver is weakening. Or it could signal that the market is starting to price in weaker industrial conditions. That's the beauty of the ratio. It doesn't need you to believe a story. It gives you something to measure. So here's my question for you. If you were watching only one thing over the next 6 months, what would it be? The gold to silver ratio, the annual silver deficit, solar demand, COMEX, and other physical inventories, or something else? And here's the question I'm even more interested in. If solar thrifting accelerates and industrial demand falls further, would that change your view of the silver deficit? Because that's where this entire thesis gets tested. The bullish case doesn't need perfect numbers, but it does need the market to remain tight enough that declining silver intensity doesn't overwhelm the growth in total demand. That's the balance I'm watching. And if this video gave you a clearer picture of silver than the usual silver is running out tomorrow story, then subscribe. Because we're going to keep looking at the numbers, the ratios, the supply, the demand, and most importantly, the arguments that can prove us wrong. No secret vaults, no guaranteed predictions, no fake certainty. Just the data, the mathematics, and the risks. And one final reminder, this video is for analysis and education only. It is not financial advice, and it is not a recommendation to buy or sell silver. Do your own research, understand the risks, and make your own decisions. I'll see you in the next one.